friends, I'm Rebecca. Welcome to Squintillions. In this video, I'm going to share with you my 5 favorite types of passive income investments. I am an information seeker and educator at heart, and I want to help people new to investing learn how to use their money to increase their wealth. The process of investing has become so much easier and cheaper in recent years through technology advances and consumer-friendly business improvements. This video covers practical advice to get beginners started on a plan to make your money work for you. If you already count yourself as an investor, this video might be too basic for you, but you are certainly welcome to stick around to hear my specific suggestions. Let's get straight to it by defining passive income, which has become a buzzword on the internet and practically overused here on YouTube to encompass all sorts of schemes it probably shouldn't be associated with. When I talk about passive income investing, I am referring to doing a little work at the beginning to set the wheels in motion, and then the money steadily rolls in for you after that. An article on Dave Ramsey's website, written by Chris Hogan, defined passive income as money you earn in a way that requires little to no daily effort to maintain. Some passive income ideas, like renting out property or building a blog, may take some work to get up and running, but they could eventually earn you money while you sleep. How do we apply this to investing? The author of The Intelligent Investor, who is also known as the father of value investing, Benjamin Graham, advised, the real money in investment will have to be made not out of buying and selling, but of owning and holding securities, receiving interest and dividends, and benefiting from their long-term increase in value. That certainly sounds like a passive income approach to me. Now on to my 5 favorite ways to earn passive income through investing. My number 1 thing to invest in for passive income are dividend ETFs. A dividend ETF is an exchange-traded fund that invests in a selection of companies that pay high-yielding dividends. These ETFs are typically composed of larger companies that have a long track record of paying dividends, and so tend to be a lower risk investment. A couple of the dividend ETFs that I like are the Vanguard High Dividend Yield ETF, ticker VYM, and the Spider Portfolio S&P 500 High Dividend ETF, ticker SPYD. Vanguard's VYM tracks the performance of the FTSE High Dividend Yield Index and invests in growth and value stocks across diversified sectors and market capitalizations. VYM is currently trading in the mid-70s, which is in the middle of its 52-week range. It has a dividend yield of 3.74%, and a dividend rate of $2.74 per share. That means in a calendar year, given the payout remains the same, you would earn $2.74 for each share that you hold. The expense ratio of the ETF is very low at 0.06%. There are 402 companies held by the fund with greater than 10% of assets in each of these sectors: financials, healthcare, consumer defense, and technology. The top 5 companies currently held are JP Morgan Chase, Johnson & Johnson, Procter & Gamble, AT&T, and Intel. By the way, I'm using the website Seeking Alpha to showcase investment information in this video. I like using this site as one of my research sources. SPYD is a fund from State Street Global Advisors that tracks the S&P 500 High Dividend Index and the S&P 500 Index. It is invested in stocks of dividend-paying companies and growth and value type large-cap companies. SPYD has been trading in the $25 to $28 range for the past month, which is on the lower part of its 52-week range. The dividend yield is at 6.75%, and the dividend rate is $1.80 per share. It has a low expense ratio of 0.07%. What is nice about holding SPYD and VYM is the added diversification. SPYD has different companies in its top holdings, including Gilead Sciences, Digital Realty Trust, General Mills, Crown Castle International, and Kraft Heinz. Its top 2 investment sectors are real estate and consumer cyclical. You have 2 options for the dividends you receive from your investments. You can have that money deposited into your brokerage account as cash, or you can have the dividends invested back into the specific investment. To make the second option happen, you need to enroll in the Dividend Reinvestment Program with your brokerage, known as a DRIP. You can toggle the DRIP on or off for each individual investment that is eligible for the program. When dividends are paid, the system will then buy shares at the current price with the cash you would have received. This is an easy way to grow your investments. I tend to have most of my investments enrolled in a DRIP. I will sometimes turn off the DRIP for an investment if I am planning on selling all of it soon, since obviously I don't want more of it. I also sometimes have turned off the DRIP if I believe the share price to be overvalued. When some of my investments were trading at 52-week highs in January of this year, I turned off the DRIP and took the dividend cash instead. I then turned the DRIP back on for those companies in early March as prices were coming down. That may be a bit more involved than most people want to be, and I recommend that if you want to be truly passive with your investments, to turn the DRIP on and forget about it. My second favorite passive income investment is similar to the first. It is buying stock in large cap companies who pay dividends. One could argue that I am covered enough in this category with my dividend ETFs, and you would be right. But I invest in such companies because I have dug a little deeper into the available information about each company. I respect how the company is running its business, and I see potential for growth in their future. I feel like I want to throw my support behind the company. Plus, by investing in individual companies, I am saving a little bit of money on costs, as there is no expense ratio to be covered. When researching individual companies, there are a few things that you should be aware of. Be careful of chasing a high dividend yield. A dividend yield percentage in the teens is a red flag. I usually like to aim for a yield higher than 2% and less than 9%. Also, check the payout ratio for a company. As a dividend investor, you are looking for a number in the middle of the range to 100. A payout ratio greater than 35% and less than 75% suggests that you will be getting a good share of the profits back from the company. When the ratio is greater than 75%, proceed with caution, as you want to consider whether or not the company will be able to sustain paying the dividend and continue to have enough money to invest back into the company. Anything over 100% is a red flag, as the company is now paying more in dividends than they earn. Note that these are loose guidelines and payout ratios can vary in different industries. When evaluating a company, you'll also want to check out other financial stats, such as the price to earnings ratio, earnings per share, debt to equity ratio, and market capitalization, to name a few. I only wanted to touch on the dividend-related information here. Be sure you have done your own thorough research so that you feel confident in your investment choices. If you are interested in finding reliable dividend companies to invest in, a good place to start is with the Dividend Aristocrats. A dividend aristocrat is a company that is part of the S&P 500 that has increased its dividends for 25 or more years. The list is updated annually, and a company can drop off the list if it fails to increase its dividend or if it moves out of the S&P 500. You can easily find the list of about 60 companies online on Wikipedia. The Dividend Aristocrat that makes up one of the largest positions in my personal portfolio is the telecommunications giant AT&T, ticker T. Their current debt load is worrying, but I see a lot of potential for this company with the rollout of 5G and their new HBO Max streaming platform. Shares are currently selling for a very accessible entry price of around $28 per share. The dividend yield is just above 7%, with the dividend rate at $2.08 per share. Don't forget that another way to make money is through the long-term increase in value of the stock you own. Make a plan in advance for what criteria you will use for selling your stock and harvesting your gains. How many years will you hold a stock? Will you set a target price at which you will sell? Or maybe you will set a percentage gain at which you will sell or begin to think about selling. You can also choose to never sell and pass your investments on to your beneficiaries. Remember that share prices can fluctuate, but dividends are not tied directly to the share price, and you should receive them whether or not the stock is valued above or below your original buy price. However, a company may choose to cut or suspend their dividends. You will want to check periodically that each of your investments is maintaining its dividends. Most financial experts recommend reviewing your portfolio at least annually. If you do not feel comfortable with picking individual stocks, It is completely fine to invest in an index fund, such as the Vanguard 500 Index Fund Investor Shares, ticker VFINX, or the Schwab S&P 500 Index Fund, ticker SWPPX. Keep in mind that the average rate of return for an S&P 500 index fund is typically between 7% and 10%. Remember that this is the average if held over a number of years. During this past decade, with the bull market run, according to US News, SWPPX returned 13.89%. If you watched my previous video, you'll already be familiar with my third choice for passive income investment, real estate investment trusts, known by the abbreviation REITs. That video introduces my experiment testing out how REITs I'm investing in through the stock market inside my E-Trade account might perform against the E-REITs in my Fundrise account. If you like what you are hearing about REITs here, I urge you to watch that video next. For those unfamiliar with this term, a REIT is a company that owns, finances, or operates income-producing real estate and may operate across various property sectors. People can own shares in individual REITs on the stock market, just like they can own shares in individual companies, and they can be traded easily, making them a liquid investment. Since REITs are required by law to pay out 90% of their taxable income as dividends, they are a steady source of passive income for investors. On the downside, REITs tend to have low growth rates of their share prices, and their dividends are taxed as ordinary income. One of the REITs that I am invested in is WP Carey, ticker WPC. WPC is a net lease REIT that invests in high-quality, single-tenant industrial, warehouse, office, retail, and self-storage properties in both the United States and Europe. I like the diversification across different sectors and locations found within this REIT. WPC is currently trading around $60 per share. The dividend yield is at 6.74%, and the dividend rate is $4.16 per share. Another REIT that is popular among investors, but which I do not currently hold myself, is Realty Income, ticker O. This retail REIT sees its share price bumping up and down near $50. It has a 5.18% yield and a $2.80 dividend rate. If you are looking at investing in REITs, you may want to consider that. With the changes in the market over the last couple of months, some REIT sectors are performing better than others. So be sure to carefully complete your research. If you like this idea but want greater diversity, investors can buy shares in REIT ETFs. My favorite of these in my portfolio are the Vanguard Real Estate ETF, ticker VNQ, and the iShares Core US REIT ETF, ticker USRT. VNQ is currently trading near $70 with a yield of 4.3%, a dividend rate of $3.18 per share, and an expense ratio at 0.12%. USRT is trading in the high 30s. Its dividend yield is 4.45%, the dividend rate is $1.82, and the expense ratio is only 0.08%. These two funds were my first foray into the world of REITs before I learned more about choosing individual REITs. For beginners, to invest in dividend ETFs, large cap companies, and REITs, you will need to open a brokerage account. I recommend opening an account with a reputable company that charges minimal fees. I personally use E-Trade and TD Ameritrade. Both offer commission-free trading, research tools, and have good customer service. I have also heard positive remarks about Fidelity, Vanguard, and Charles Schwab. In the last couple years, there's been a trend for mobile investing apps, such as Robinhood, M1 Finance, and Webull. With so many of these platforms now offering commission-free trading, it is okay to buy one share at a time so you can build wealth little by little with what you have. These apps are a nice way for a beginner to get started, as the apps have simplified user interfaces for ease of use. These apps also offer sign-up bonuses when you sign up using a referral link. If you would like to use any of my referral links, they are in the description below. If you want to do some research before choosing a trading platform, then do a Google search for best online brokerage accounts or best investment apps. If you are viewing outside of the United States, just add your country name to the end of your search. The stock market has shown a lot of volatility over the past several weeks. One day it's up, the next day it's down. Please think carefully about any investments you want to make right now. If you are thinking of investing in ETFs, individual stocks, or REITs, as I've talked about, only invest enough money into the stock market that you can afford to spare, and know that you might need to leave it there for a while to ride out any lows we may see. Please note that this video is for educational and entertainment purposes only. While I share a lot of my opinions and give suggestions, this should not be considered as professional financial advice. Always complete your own research before investing in anything. If you do feel like you're gaining something from this video, I'd appreciate it if you'd hit the like button. On to number 4 of my favorite passive income investments. I mentioned it briefly earlier. It is Fundrise. Fundrise is a crowdsourced real estate investing platform that allows people to diversify outside the stock market. It is also a way to invest in real estate without having to personally manage the buying and selling of properties, maintenance, home improvements, or tenants. Money deposited in Fundrise should be thought of as a long-term investment, as your money is locked into the platform. Given the lack of liquidity in the underlying asset of real estate, Fundrise has temporarily suspended account redemptions, which means if your money is in Fundrise, you are not getting it out right now. Fundrise has written a detailed explanation about this to account holders, saying fulfilling redemption requests in today's environment would mean either substantially depleting vital cash reserves, or even worse, potentially selling assets into a down market, and likely at a price far below actual value. I'm fine with this, as I always understood this to be a long-term investment, and also because I have just $1,192 in my Fundrise account. I will likely add about $600 into this account this year. I'm taking a conservative approach while I watch how this company operates. One of the reasons I like Fundrise is because despite the drop that happened in the stock market, my Fundrise account continued to grow. All the dividends I have earned through Fundrise have been automatically reinvested in their e-REITs. I've had a return on investment in this account of 8.3% over the 15 months that I've been invested. We have reached my final choice for this list, and it is the easiest option for generating passive income, though with the smallest return. High interest rate savings accounts are my favorite place to park my cash that I don't want to have invested elsewhere. I use the Capital One 360 Performance Savings Account with an interest rate of 1.5% APY and the Discover Savings Account at 1.4% APY. One of the accounts is dedicated to saving my cash for a future down payment on a house, and the other holds my emergency fund. I like to keep my emergency fund in a different bank from the one that I regularly use. That helps me leave the money there and only access it for a true emergency. Keeping your cash in a high interest rate savings account is not going to make a lot of money for you. Most of them will barely keep pace with inflation. But for goals or situations where you need to keep cash available, I feel that this is the best option. For US-based viewers, if you want to open a high interest rate savings account, use the website bankrate.com to search for the best current interest rates and the bank that you want to use. On the website homepage, click on the box for Savings MMA accounts. Then you can enter the details of how much your initial deposit will be, choose your account type from the drop-down list, enter your zip code, and choose how you want the results to be sorted. When you get the results back, click on the All Products tab to see many more options. Some banks will offer incentives for you to open accounts. Some accounts have requirements, such as maintaining a minimum balance or using direct deposit in order to get the good interest rate. Others require a minimum initial deposit. Further, there may be limits on how often you may withdraw or transfer money from the account each month. Remember, when you are reviewing these accounts, to closely examine the terms for each account offer. Let's recap my 5 favorite ways to use my money to earn passive income. Dividend ETFs, stock and large cap companies, REITs, Fundrise, and high interest rate savings accounts. What is your favorite way to earn passive income? Please comment below. If you found this video helpful, remember to hit the like button. Don't forget to subscribe to learn more about personal finance and personal growth here on Squintillions.